Date range, 20th, October 2025 to 24th, October 2025. Let me set the tone quickly and clearly. I am neutral with a mild bullish tilt, and I want to respect both sides of the tape while acknowledging that buyers still have the initiative. The focus for next week is straightforward. I am watching the zone from 6688 to 6900, which captures both the recent momentum and the upper psychological magnet that traders will talk about all week long. At the top, 6900 is the clean psychological round number that can attract price if momentum keeps pressing. Beneath, I consider Friday's open near 6,788 as soft support because that is where short-term bulls can defend the breakout, and I mark 6,688 as hard support if bulls remain in control and need to absorb a deeper test. Two macro markers are on the calendar and they fall on Wednesday. ADP non-farm employment change and the non-manufacturing PMI can nudge intraday tempo and they can influence whether a breakout breathes or pauses. My Monday action plan has two paths. If we gap up, I will enter long and watch how price behaves around the all-time high, which is about 6,841.75, and I will trail stops only. Upside probability is elevated, and 6,900 becomes a reasonable magnet if momentum sustains, and I am open to holding winners since the market may need more than one session to climb into that area. If we gap down, I will enter short and monitor the reaction near 6,800 since that level can act as a temporary support and spark a bullish reversal if buyers show up. If that shelf fails, I will target Friday's low, which is about 67.77, while remembering that the broader wedge structure on the daily chart and the potential double top before a larger sell-off remain unresolved. The recent breakout on last Friday does not yet have clean confirmation, especially after the large bear bar earlier days ago, and yet the printed structure still indicates strong bullish momentum. In short, I will let price lead and I will favor the path of least resistance while being quick to lock gains and to re-anchor if we rotate. With that quick roadmap in place, let us zoom out to the monthly view for context that can anchor the week ahead. On the monthly chart, the message is simple. The trend is undeniably bullish and the burden of proof is on the bears. We have a parabolic climax character to the advance, and price has broken above the upper trend line with two consecutive bullish bars, which is the kind of strength that often forces late sellers to cover and sidelines traders to chase. We also have 6 straight bull bars with negligible pullbacks, a rare run that we last saw from February to August 2021, and that history tells us that when the market achieves this kind of persistence, the next phase tends to be a transition rather than an immediate and durable reversal. The key observation is that bullish momentum since May has been relentless with no bear bars and with pullbacks that have been small and brief. This persistence is notable given minimal relief from central bank policy, and it suggests that both the technical picture and the underlying narrative still point to continued upside potential. In a parabolic climax scenario, even if we see a sharp correction, the odds favor consolidation into a year-end trading range at roughly 7 parts out of 10 or even 8 parts out of 10. When I translate that into tactics, I avoid aggressive shorting on intraday moves and I favor buying dips for multi-day swing trades when the tape offers a logical setup. The worst-case outlook on this timeframe is a reversal in the coming weeks that could test the zone from 64.22 to 65.42. If we reach that zone, I would expect two-sided trading as longer-term participants debate value, and I would still be looking for signs of a base rather than assuming a sustained downtrend without fresh evidence. In terms of levels to watch, resistance remains the psychological 6,900 area overhead, which is a clean marquee number that funds and media latch onto. For support, 67.24 is critical for this month's close because it is the line that helps decide the bar type. A close above keeps the bull bar narrative intact, while a close below risks a shift in tone that could encourage a pause into the next month. I also mark 6,688 because, if a bear bar forms, I want to watch whether price closes below the monthly bar midpoint and what that implies for November and December. My plan on this time frame is to respect the strength, to prefer pullback entries, and to avoid forecasting a top before we actually see topping behavior. With the monthly backdrop set, let us step into the weekly view to connect the big picture with the latest price action. On the weekly chart, the trend remains bullish, and the market has broken and closed above the prior all-time high. We closed the week with a large bull bar that finished at its high, which is a signature of strength and a sign that buyers were willing to hold into the weekend. Price is traveling at the top of a tight micro bull channel, and, while that can be late in a swing, it still has room to run when momentum is persistent. There is also a mild breakout above a larger trading range, and I treat this as a breakout in search of follow-through rather than a final destination. The path to this close was not a straight line. After the earlier large bear bar, price formed an expanding triangle on the lower time frames. The upside resolution on Friday confirmed robust bullish momentum, but beneath the surface there was nuance. The weekly bar closed at its absolute high, and it did so above the former all-time high, but the regular session action on Friday formed a range and closed near the bottom of that range. The core of the move came from a single pre-market bull bar, and the cash session largely digested that impulse. That is not a bearish statement. It simply says the market used up a lot of energy early and then paused to refuel. In a tight bull channel near the highs, this kind of pause is actually constructive if the next week can print even a modest follow-through bar. For levels, I continue to anchor on the all-time high at 6,841.75. If price breaks above that area with only a trivial pullback, then 6,900 becomes the next obvious target where I would expect the pace to slow as traders book gains and fade attempts to overextend. On the downside, the high of last week at 6,766.75 is important because a pullback that holds above that area keeps the bull breakout narrative clean and gives buyers an easy place to step back in. For tactics this week, I plan to buy shallow pullbacks and to be patient with profits as long as we keep closing well and holding above prior breakout levels. If we dip, I will look for a higher low that holds above last week's high to re-engage the trend. If we break out early, I will look to join with a tight stop and a plan to scale out into strength rather than hunting a home run. With the weekly frame in place, let us drill down to the daily view to fine-tune the triggers and scenarios. On the daily chart, the trend is bullish and the structure shows possible 3 pushes up inside a tight micro bull channel. Thursday delivered 2 consecutive bull bars that both closed at their highs, a clear sign that buyers were eager to mark the close and accept price at higher levels. The broader message is that the market still favors bulls. Even after a strong bear bar that offered no follow-through, price quickly made a new all-time high. I do not doubt the momentum, yet I am mindful of climax behavior when a micro-channel stretches. The odds of further upside remain above 50%, but this could be the final push before a deeper pullback from the higher time frame perspective. Last Friday's bull bar matters because it confirms the uptrend remains intact. The pullback on Wednesday respected the daily EMA 20, and importantly, no daily bar has closed below the daily EMA 20. The worst that I expect in the near term is a retest of that EMA 20 line before buyers try again, and that dip, if offered, would be a location to look for a higher low. Next Monday will be a useful tell because the regular trading hours on last Friday formed a range rather than a clear bull trend. We may see a pullback on Monday to retest Friday's open at 67.78, and I will watch closely to see if buyers step in below that level and defend the breakout zone. For levels to watch, I have the all-time high at 6,841.75 as resistance. If price breaks that area with only a small pullback, the next target becomes 6,900. For support, I mark 67.78 as the open of the last breakout and also last Friday's open. I also note 67.27, which is the open of this month, since it will help decide whether the month closes as a bull bar or a bear bar. Finally, I keep 66.88 as a 50% pullback of the current monthly bar because movement toward that area would be a strong signal for the direction of November and December. Tactically, I will look for a small pullback bull trend to continue if Monday holds above 67.78, and I will shift to buy the dip mode if we tag the EMA 20 line. With the daily map set, let us review the 5-minute action from last week to extract precise lessons for execution. Last Monday opened with a gap up, and the plan from the prior post was to go long if price gapped above the bear flag. That script played out well. From an Al Brooks perspective, the market quickly shifted to always in long, and the cleanest tactic was to enter and trail as bars kept closing near their highs. The key management detail was the use of trailing stops and the idea that a trend day can offer a measured move without requiring prediction. The low of bar 14 served as the final trailing stop, which is consistent with the method that says protect the swing once a rally starts to stair step. The 1x money management target hit at bar 43, and if you entered long on the very first bar, the daily profit and loss would land around 40 points after slippage. The structure favored buying pullbacks rather than trying to fade, because each push down lacked follow-through and the context was a breakout above a bear flag with bulls pressing. When bars widen early, the Brooks approach is to scale in small on pullbacks and to reduce risk by moving the stop under higher lows rather than hoping for a big exit at the top. The long-only bias remained valid until the first credible reversal attempt that showed 2 legs down and failed to make a new high. That moment did not arrive until late, which is why the simplest plan, buy and trail, outperformed. The lesson is that when a session opens with a gap above a bear flag, you let the bulls prove a failure before you switch hats. With Monday harvested, let us step into Tuesday, where the picture was far more two-sided and demanded tighter risk control. Tuesday was choppy and bounded, and it required patience. We opened with a negligible gap down and then formed a tight bear trend through the first 8 bars before a sharp reversal. A large bear bar printed at bar 11, but it had no follow-through, which is a classic clue that the bear push was suspect. The strongest entry of the day came above bar 13, where a higher low closed at its high at the session bottom. That is a textbook place to buy in the Brooks method because the higher low shows that sellers could not push through and the close at the high shows urgency from buyers. Using 2x real risk, the target hit at bar 40 for roughly 19 points, which rewarded disciplined position sizing and clear target selection. Trailing worked only if your target was realistic because the day never transformed into a clean trend and late longs gave back open profits inside the range. The trader's equation favored buying strength at that higher low because you had a strong bull signal and a good context at the bottom of the session structure. Fading into the range without a signal would have been a low-quality bet because the downside had already lost momentum. Into the afternoon, the right play was to scale out at logical magnets and to keep stops tight, since wide stops did not improve outcomes in a range day. The takeaway is that on a choppy day, you need to be paid quickly and you must accept that most trades are 1 or 2 legs at best. With that mindset reinforced, let us see how Wednesday offered a clearer short early before rotating back to buy signals later. Wednesday opened with a gap up, but the first 5 minutes produced a large bear bar. In the context of Monday and Tuesday, that was enough to shift the short-term plan. Bullish momentum had cooled, the broader structure was still an expanding triangle, and the early bear signal had room to test lower. From an Al Brooks lens, that meant shorting was viable and the trade management was straightforward. Use trailing stops under lower highs and let the market decide whether you get 1x or 2x measured move based on the height of the morning range. The bear move gathered strength and Monday's gap was fully closed after strong selling around bar 37, which validated the short bias from the open. For scalpers, the late session flipped the script when two distinct bull bars at 52 and 54 printed and held. That was the first credible sign that buyers could take a swing, and both one-time and two-times measured moves materialized cleanly into the close. The key lesson here is to align with context. An expanding triangle asks you to take both sides when signals are strong and when the opposing side fails to push through. Early, the sellers had control by signal and by follow-through, so you pressed the short. Late, the bulls printed back-to-back strength at a logical place and you switch. The day rewarded traders who respected signals and avoided opinions. With the midweek rhythm understood, let us turn to Thursday where the bias returned to the buy side but still demanded patience. Thursday opened flat with no gap, and the weekly context favored bulls a little. The worst case looked like a trading range, and price sat near the bottom of that range early. The key question was how far any upside could run before supply surfaced. The clean plan was to enter long after two consecutive bull bars, maintain a bullish bias as long as the market kept printing higher lows, and use a trailing stop with a target at the weekly high. That target paid at bar 58, which validated the simple plan to lean on context and let the market do the lifting. Through the session, pullbacks were shallow and had small bear bodies, which is exactly what you want to see if you are holding along with a time stop and a trailing stop under swing lows. The lesson from Thursday is that when the higher time frame leans up and intraday pullbacks are weak, you can simplify your trade selection. Buy strength after confirmation, protect under higher lows, and pay yourself into the obvious magnet. With Thursday's structure resolved to the upside, let us finish with Friday, which opened hot but refused to trend and forced a more defensive playbook. Friday surprised many traders. The market gapped up more than 45 points on news, yet we did not see trend continuation during regular hours. Swing traders struggled to stay profitable with stop orders because the tape transitioned into a range with a grind higher built from a series of higher lows but without clean bull follow-through. In an Al Brooks framework, this kind of day calls for caution. You reduce position size, you demand strong signals, and you keep your risk tight because the market is telling you that both sides are fading each other around reference prices. Despite the higher lows, bullish momentum remained weak inside the cash session, and that means you respect the possibility of a pullback to test nearby support. I will keep an eye on 6,812.5, which is Friday's low and likely weak, on 6,800, which is a round number and also weak, and on 6,778, which is the open of the last breakout and last Friday's open. Those are the logical places for buyers to try again if we dip. The method for a day like this is to let the market show its hand at those supports. If we see a two-leg pullback into 67.78 followed by a strong bull signal, that is where the risk-reward improves. If supports fail without a signal, step aside and wait for a fresh setup. The headline for Friday is that the early gap was noise for cash session traders and the edge came from respecting the range and protecting capital. With that reflection in place, we close the review ready to apply these lessons to the coming sessions with clarity and discipline.